Everybody, this is Jim at SP500chart.com. It is March 24th, 2013, a little after 3 o'clock in the afternoon here on the East Coast of the U.S. And we're going to look at the S&P 500 chart, going to look back, see kind of what happened during the week that ended March 22nd, and we're going to look and see, what happened on Friday, specifically on the 22nd as well. Before we do so, I just want to remind you, as always, that the website and the video are for educational purposes only. Nothing stated at the site or in the video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. I'm not a licensed financial professional. I am just a guy who draws lines on charts. Okay, we're going to start looking at this hourly chart. Now, I want to remind you one thing, and this is my sales pitch, so here it goes. If you are looking at this video and you're wondering, gee, it sure would be nice if I could get a video like this after each day's close, I've got good news for you. You can. It costs $19.95 a month, and you get a video after every day close, with rare exceptions. I think in the past year, maybe I missed 3 days due to either a technical issue or travel. But I really take this seriously to get these things done. So please consider that. If you look at this and you say, wow, I like what I see here with trend line analysis. And you'll notice that what I do is specifically trend line analysis. Every now and then, maybe a moving average. Every now and then, maybe a little something else. But the vast majority of what I do is good old-fashioned trend line analysis. So consider that. Go to SP500chart.com, sign up, and every subscription starts with a 2-week trial. So guys, think about it. If you are already a subscriber, I want to thank you so much for what you've enabled me to continue doing on a daily basis. I know you do it because you feel it's worth it. But I want to say it also, literally, it sustains this effort. So thank you so much. All right, let's look at the chart. First off, when we look at the week and we're looking at an hourly chart, we see a week that ended very, very close to where it started. And we'll take a little bit closer look at it. But what we're looking at right now is an hourly chart. And what I want you to see is this. Here is the beginning of January. You remember we gapped up on January 2nd, and we immediately started running in this channel. At a point, we reached a point in time when the channel broke in mid to late February, at which point we formed an inverted head and shoulders pattern, which tells us that this break was not to set up a reversal, but this break was to set up a consolidation. We've seen this before. If we go back to a much larger chart, we can see a couple of breaks. This was a break of a trend line that happened back in 2010, initiated by the, quote, flash crash. But it served as a continuation pattern because we made an inverse head and shoulders, and then we came up to set new highs. So when we were looking at this year, we came up, got up over 1,500, came down, not to reverse, came down to consolidate, and then to continue with more upside action. So remember that. We broke a channel, consolidated, then we continued back up. Interesting to note that as we continued back up, the line that I'm now highlighting served as, I want to say it served as resistance, but it's kind of funny the way it worked. You can see that the S&P just kind of wrapped itself around that line, almost like the price action was a vine climbing up a trellis. It just would go up above it a little bit, down below it a little bit, up above it a little bit, down below. The whole for almost 2 solid weeks. This is what took place. Interesting. So you could tell that this line still has technical significance. We are now under this line for the second time, having really solidified that downward move on starting with our first day of trading of this past week. Looking at this same section in a little bit more detail, here you see that red line, and you can see the price action just hugging that line. Then here we come on Monday, right here, really gapping down, and now this line has served all week and will likely serve for, well, potentially all of known for all of, well, I say all known. Frankly, this line could be resistance from now till kingdom come. Okay, because it is a rising line, and there are plenty of rising lines in the market that will never get reached once they broke. This may or may not be one of them, but because it's rising, you can see that if the market makes any substantial move to the downside, then this line really becomes simply out of reach. It doesn't mean the market will never rally. Doesn't mean the S&P will never reach 5,000. It means that if we were to reach 5,000, it might happen at such a time where this line is 12,000. Yeah, that's what I'm saying. So right now we expect this to be resistance. We also expect this little blue line to be resistance as well. One thing that is kind of interesting is we identified a potential descending channel, and identified this pattern really based upon just a couple days of trading, which makes that call a little bit less trustworthy than if we'd had a little bit more time to see this develop. But we had 2 bottoms with that gap down on the 18th, and then again the intraday low on the 19th, and then we had a few little tightly grouped tops from late the week of the 11th, and then again late on Monday and early on Tuesday. So I drew this line kind of with the idea that this might play technical significance. Interesting that on the 20th, when we got over that line, we back tested on the 21st, moved underneath it briefly, got back on top, back tested it again on the 21st, and it looks like this line is producing a bounce. So we're going to leave this here, but I'm going to put a new line on the chart. And again, I don't know if this is a perfect position for this, but I'm putting this line right now, right here. This could change in a couple days. So you see what I'm looking at, don't you? I'm seeing, like, remember I mentioned we broke this red trend, this red channel, made an inverted head and shoulders, established another little channel here. Could we be making yet another inverted head and shoulders pattern right here? Well, could very well be. And if so, this likely would be the neckline. Now, if this turns out to be the case, and until it breaks over this neckline, then this is just me with some harebrained idea. But if that were to be the case, then we would be looking at a move likely to the low to mid 1580s as a result of a break of this neckline, if this turns out to be an inverted head and shoulders. So that is a potential bullish setup. And one of the reasons I'm a little bit comfortable mentioning this is the fact that we did this downtrend between these two orange lines right here, that got cut off. We broke up out of that on Wednesday, and it looks like the market is showing signs of firming up. Now, you might say to yourself, well, Jim, okay, let's say we do get a confirmed head and shoulders pattern. What about the resistance from this red line? What about the resistance from this blue line? Well, you know, since those are lines that ascend, then if it breaks out, the pattern could come to its target as really as early as, well, hold on. Sorry, I had to consult because I saw on the chart here that we show the 29th and as a trading day, and it should not be. That is that not Good Friday? So anyway, to make a long story short, we got about a week or so before that 1580-ish, 1580 target, depending on when the break were to occur. If it occurs, then that target could be met and still be underneath this line. Testing this line again with a back test would be really what it would be. But if this is an inverted head and shoulders pattern with a target of about 1584, 1585, that target can be reached without violating any of what we expect in the way of technical tendencies in about 5 trading days. So that is a possibility. Now, as far as the week goes, let's look at a 10-minute chart, and we'll show you. Here was the break on Monday, a solid break of this line. And once that broke, we knew not to expect, because that was a technically significant break, not to expect the market to rush back up into this channel between either this larger red channel or the smaller blue channel. Instead, we would expect either downwards or sideways action. What we ended up with was sideways. So that being the case, I think we need to be on the lookout for this line. If it breaks, then we know to look for something in the mid-1580s. If this doesn't break and we come down and start plowing through some other levels of where we would expect support, then it's a totally different ball game, totally different picture. But I'll remind you that we are expecting, if the market does come back down deeper, I would expect a bounce at the neckline from this inverted head and shoulders pattern. That would likely bounce us back up, at least for a short-term little leg up. If we come down and start taking out some more serious levels of support, most notably this yellow line right here, then I would expect a more serious sell-off. Now, I pointed this little pattern out here as a potentially bullish pattern, okay? And we've seen one bullish pattern after another. There comes a point in time when it's not going to be all bullish, when the market's going to turn over. And I tend to think that we're getting very close to some areas in the long-term chart where we would expect to look for a top to form. And you can see just how close we are What's funny was way back in 2009, in the summer of 2009, when the S&P was under 1,000, I was on some message boards. I didn't have my YouTube channel, didn't have sp500chart.com, but I was saying, look, if we get over this, 980, I think was the mark. I said, if we break out over 980, you can look for 13 to 1350 with about 80% certainty. And I even mentioned then, just kind of off the cuff, I said, and if it gets to 1350, I see no reason for that move to not keep on until we test previous levels of strong resistance. And it looks like we're very likely getting to that point. So I'm not saying that meant I was smarter than everybody back then, but this was an inverted head and shoulders back here. You have to trust that. You have to respect that. So looking again at just this pattern, there you go, inverted head and shoulders. I think you've got to call it for what it looks to be, and this would be the neckline. If it breaks out, then we look for 1580s, and that's awful close to that resistance line that I just showed you on the 9-day chart. Let me show you a less pretty picture. Let me go to, I think I could show this on an hourly chart. We're also keeping our eye on this line down below us, which is around 1490 and change. We have already had one pretty good test of that line. You could see here that occurred in late February. If we take out some support, some more serious levels of support, and let's say the market's ready for about what would that be, from where we are at 1560 down to 1480? That's only what, about a 5 to 6% correction. I say correction, it's that's kind of a funny word, but a 5 to 6% haircut. If we were to come down here, then rally back up, then come down and take this out, and you know what I'm seeing, then we may be looking at this line playing a significant role, maybe in another head and shoulders top that could form on a longer term basis. Finally, I want to show you one more thing, and I'm not a big believer in taking old wives' tales or old adages or anything that rhymes. Not everything that rhymes is true. And one of the things that people have always said is sell in May and go away. I do want to show you that made sense in May of 2010. If you were willing to buy the bottom back, it made sense in May of 2011. If you were willing to buy back in, it made sense in May of 2012, but only if you were willing to buy back in. And now, here we go, coming up, just about a month and change away from May of 2013. I'm not saying this because I believe the rhyme makes it true. I'm saying this because it sort of looks like it may just be destiny. If we were to come up to this line and get up to and tag somewhere up around the very high 1500s or right around 1600, and it's May, I'm thinking I'll let the rhyme sway me this time. So, for what it's worth, just pointing that out. For the last 3 years, that did turn out to be what would have been a good move. But I suspect before we get to any place to where we make a decision based upon an old wives' tale, if you will, I suspect we'll see something in the chart. So guys, that's where we stand. That's the weekly review, and really it's very basic, breaking the channel, but then going sideways throughout the week. And that's not a typical behavior. We've seen it before. It usually leads, or I say usually, in many times over the past few years, that has led to a new leg up. But this would be the trigger point, I think. This line could change, but I'm thinking this is probably about where it should be. If the market can rally significantly above, let's say, if it can set a new closing high, higher than anything we've seen in the month of March, then I think that is a good signal that we're going to get up into the 1580s. And look how close that will be to that all-time, well, I say all-time, to that line that is drawn over the last three major tops in the S&P 500. Just something to think about. So let's go into this week, see what happens. And guys, I want to thank you for watching. Thank you for your subscription. And once again, if you're not, you can. And each subscription starts off with a 2-week trial for only $4.95. Thanks. Take care.